Hey everyone, and welcome back to The Explainer. Today we've got a really exciting and focused goal. We are going to completely demystify one of the most complex, yet absolutely essential metrics in the banking world, return on equity, or ROE. Let's break this down step by step. But before we even look at a single formula, I want you to really think about a fundamental question. How do you actually measure a bank's true success? Often we just look at the sheer size of a bank, how many branches they have, or the massive scale of their loan book. And sure, size definitely matters. But true success in banking, it doesn't rely on scale alone. It relies on a very specific profitability scorecard. And that is exactly what we're unpacking today. Okay, let's dive into this. Here's our 4-step roadmap for today. First, the lemonade stand analogy. Second, defining return on equity. Third, the ROE reality check. And finally, valuing the bank. All right, section 1, the lemonade stand analogy, understanding bank capital. So to really grasp these advanced banking metrics, we first need to ground the whole concept in something universally understood. Imagine you're a 5-year-old running a lemonade stand. You borrow money from your friends or family to buy lemons, you make the lemonade, and you sell it for a profit. But the grown-ups make one really important rule. You are not allowed to run your stand using only other people's money. You have to put in a chunk of your own pocket money and keep it in the stand. Why? Well, if kids take lemonade on credit and just vanish without paying, the loss eats your own money first. That pocket money is quite literally what keeps the stand from shutting down. Now put your senior equity analyst hat on. That pocket money concept translates directly to the real world. That is exactly what we call bank capital. Capital is the bank's own money, held as a core buffer to absorb unexpected losses without collapsing. Think of it like a giant shock absorber. It cushions the bank when loans go bad, ensuring that the bank's depositors, the people who supplied the rest of the money, are fully protected. Moving on to section 2, defining return on equity, the dual lens. Let's bring in the core metric of our explainer. What's super interesting here is how we can look at the exact same number from 2 totally different angles. On one side, you have the 5-year-old's view. At the end of the year, your mom asks, out of the pocket money you personally put into the stand, how much profit did you make on just that specific money? On the flip side, we have the senior equity analyst definition. Return on equity, or ROE, is a bank's net profit expressed as a percentage of shareholders' equity. It is exactly the same question, just dressed up in fancy financial terminology. So the crucial point here is understanding how banks actually operate. ROE measures the return purely on shareholder money. But banks deploy far, far more assets, meaning loans, than just their base capital. They take that base capital, stack tons of deposited money right on top of it, and lend it all out. Because they use so much of other people's money to generate their profit, their return on equity runs inherently higher. And this leads us directly to a very sharp, double-edged sword: leverage. Which brings us to section 3, the ROA reality check, the power of leverage. Here is the crucial twist where we see why looking at ROE completely on its own can sometimes be a total mirage. As the source material points out, ROE runs higher than ROA because banks are inherently leveraged. If a bank is generating a massive return on equity, it doesn't automatically mean they are this brilliant, flawless lending machine. Actually, it might just mean they're heavily borrowed, spinning a tiny bit of real profit over a massive pile of borrowed cash just to make their equity return look huge. And this brilliantly illustrates the point. Picture a tiny sliver of equity, that's our pocket money. Now stack a massive tower of total deployed assets right next to it. When you measure profit only against that tiny sliver of equity, the percentage looks absolutely fantastic. But doing that completely ignores the massive risk taken on the asset side to get there. We need a way to strip out that leverage. And that is exactly why we use ROA. Return on assets is net profit as a percentage of total assets. This is your ultimate leverage-neutral scorecard. Pure scale and borrowing just cannot flatter it. It asks one very simple question. For every 100 rupees of stuff the bank holds, all the loans, the investments, the whole shebang, how much actual real profit did it bring home? To put that into perspective, for Indian banks, an ROA above 1% is considered good, and anything above 1.5% is excellent. It reveals a bank's true underlying quality. So let's break down this reality check matrix. If a bank has a high ROE and a high ROA, that's genuine quality. But consider the flip side. A bank can totally post a high ROE while having a razor-thin ROA simply by piling on heavy leverage.
This is a super common trap, especially when looking at certain public sector banks. A high ROE built purely on a thin ROA and heavy leverage isn't a success story, folks. It's dangerously fragile. All right, so here is your one-line takeaway for this act, the golden rule you absolutely need to memorize. ROE is profit on shareholder money. It's higher than ROA because of leverage, so the two must always be read together. Never, ever let a bank brag about its ROE without immediately checking its ROA.
Let's move to Section 4 and see how this builds. Valuing the bank, bringing it to the real world.
Now that we've got the core metrics down, how do analysts actually slap a price tag on a bank's stock? Well, unlike industrial companies where we look a lot at price to earnings, banks are fundamentally valued on their book value. That's because a bank's assets are purely financial in nature. Therefore, the primary multiple we use is price to book value, or P/BV. It's simply the share price divided by the book value per share.
So how exactly does a bank earn that premium valuation in the open market? It comes down to a very specific, logical three-step sequence. Step 1. The bank has to prove genuine, underlying asset quality and spread efficiency, which gives them a high ROA. Step 2, they use healthy, safe leverage to turn that high ROA into a high, consistent return on equity. And Step 3, the market rewards that high, consistent ROE by assigning the stock a higher price-to-book multiple. In fact, seeing a multiple above 2.5 times usually signals you're looking at a true premium franchise. Which brings us to the ultimate takeaway from our source material. Listen to this. The relationship between ROE and the price-to-book multiple is the core of bank valuation. If you understand this relationship, you truly understand the engine that drives bank stock prices. And that leaves us with one final provocative thought. The next time you see a bank reporting a record-breaking return on equity, ask yourself, if that high ROE is built mostly on heavy leverage and a razor-thin ROA, is it truly a premium franchise? Or is it just a house of cards waiting for a breeze? Keep that lemonade stand in mind and always check the ROA. Thanks so much for joining me on this explainer, and keep learning.